Hi there, and welcome to the March 2021 edition of CUNA's Economic Update, a video review of economic developments and how they might influence credit union operations, and more importantly, perhaps, how they might influence credit union interactions with members. I'm CUNA Chief Economist Mike Schenk, and in this month's video review, I've got three key topics that I want to cover real quickly with you. But before I do that, I just want to thank Co-op Financial Services for their support of our efforts. They sponsored this video update, and we thank them for their collaboration and look forward to more of it in the future. So without further ado, let's dive into the March economic update. Well, the first thing I want to do today is share with you a little bit of premium content. Now, I know you might think that's a little bit strange. Most presenters will save their premium content to the end of their presentation. I'm going to put it right up front. It matters so much that I've pulled it to the front. Not going to make you wait till the end of the presentation to see this. What do I mean by premium content? Well, today what I mean is the share insurance fund and whether or not there will be a premium in the not too distant future. We've heard from a lot of credit unions who tell us that they're hearing from their peers, they're hearing in the trade press, and they're hearing in some cases from NCUA leadership that a premium is imminent. So let's talk a little bit about what the insurance fund looks like today and what we think the way forward ought to look like. As you may recall, the normal operating level on the insurance fund today is 1.38%. That essentially means that the normal operating level should be equal to, if we were to take a calculation of the 1% deposit, 1% of insured shares that each credit union is required to deposit into the fund, plus all the retained earnings adjusted for things like unrealized gains and losses on securities. Add those two things together and divide by insured shares. That normal level should be 1.38% according to NCUA leadership. Now, you may recall that at the end of 2019, the insurance fund ratio, that 1% deposit, the whole pile of money there, and the retained earnings was equal to 1.35%. That was the beginning of 2020. By the end of 2020, the insurance fund ratio fell to 1.26%. And the reason for that was kind of strange in the context of an economic disruption. This did not occur because credit unions were seeing big increases in delinquencies, big increases in losses, and that there was an increase in credit union failures. No, that wasn't the case. The entire effect here that we see, the drop from 1.35% to 126, is essentially the result of very fast asset growth. As you know, assets grew at nearly 20% last year. Insured shares grew at a rate of nearly 20%. And despite the fact that large credit unions had to basically true up their 1% deposit in the middle of last year, that ratio finished the year at 1.26%. Now, the insurance folks that oversee the insurance fund at NCUA are only required to charge a premium if the insurance fund ratio falls below 1.2%. They cannot, by statute, charge a premium if the insurance fund ratio is above 1.3%. Now, what we think is going to happen here in the not too distant future is that after the NCUA basically sends out invoices requiring each credit union to true up its 1% deposit, that we will see the fund ratio rise from about 1.26% at the beginning of this year to about 1.31%. And if that's the case, then the NCUA would be prohibited from charging a premium. Now, that may be the case and may not be the case. There are other things going on in the background, of course, that we need to be concerned about. So, for example, when we see an increase in longer term interest rates, you basically see an increase in unrealized losses in the insurance fund's investments. The last time I looked, about 25% of credit union of the CUSIF's investments were in investments that had a maturity of 5 or more years. So an increase in longer term interest rate would have a negative effect on on the unrealized losses that the fund would have to record. The other thing that's going on, of course, is that at some point in the future, after the $5 trillion or whatever it ends up being, $1 trillion of federal stimulus and help for economic entities throughout the nation, when that starts to wear off and when the moratorium on foreclosures and evictions wears off, there is an expectation that asset quality will deteriorate. Nobody knows to what extent, but there is an expectation that asset quality will deteriorate to some extent, and that may, depending on if it's severe, basically increase pressure on a lot of credit unions and increase the number of credit union failures. So to the extent that we have unrealized losses and the extent we have failures, that will put downward pressure on this ratio. And of course, the other thing putting downward pressure on the ratio is growth in insured shares. Nevertheless, we think the ratio is going to be at about 1.3, above 1.3% very, very soon after all those invoices are paid. And that gives us some level of comfort that there will not be an imminent premium charge to credit unions. Doesn't mean it's off the table, doesn't mean it won't happen down the road. As I say, if those asset quality numbers deteriorate significantly, and if we see a big decline in credit union financials that result in failures, then more than likely we'd see this ratio come down and pressure would build for a premium. Now, there wouldn't necessarily have to be a premium if the ratio fell below 1.3%. That's at the discretion of the NCUA. And based on history, we would argue that credit unions have performed, and the SIF has performed very well historically with an insurance fund ratio throughout the economic cycle that has stayed above 1.2%. In contrast, if we look at our brethren in the banking industry, you can see there have been two occasions in the last 30 plus years where the FDIC basically went negative and stayed negative for a couple of years. That has not happened to credit unions at any point across this broad historical perspective. The other thing to consider is that credit unions really are different. We are actually being told by the NCUA to step in and step up and to help people through the crisis. And so that does basically produce situations where we're waiving fees and we're not foreclosing and not evicting people, or our members are not evicting people because we're helping out. So when we look at this broad historical perspective, we think that there's a solid argument to be made that even if the fund falls a little bit below 130 and stays there for a little while, there really won't be a need to charge a premium anytime in the near future, and especially during the middle of the effects of the pandemic and the economic crisis. So doesn't mean it won't happen, but over the short term, we do not expect to see a premium being charged to credit unions. So that brings us to our second topic, hit and miss. Hit and miss is just a review of economic metrics and financial metrics that seem to be tracking either pretty closely with CUNA's baseline forecast or departing from that forecast, and the implications for each of those outcomes. So first thing I want to hit on is the fact that the Federal Reserve Chairman Powell on March 23rd met with congressional leaders. And in his statement to Congress, he basically said that he expects that inflation will increase going forward. That's in line with what CUNA forecasts into the future as well. However, he said the Fed does not expect the effects of inflation will be either particularly large or persistent. Again, that tracks with what we're thinking here, both at CUNA and CUNA Mutual. So that's lining up with what our expectations are. The other really interesting thing that Chair Powell said is that the Fed welcomes the progress that has been seen so far, but they will not lose sight of the fact that millions of Americans are still hurting, and especially folks, he called out folks that are on the lower rungs of the economic ladder and minorities in particular, a great concern to the Federal Reserve. And so taking his statement together essentially says to us that our forecast is in line with what the Fed is thinking, which means more than likely the Fed funds interest rate will be, effective interest rate will be right around 10 basis points as far as the eye can see out into the end of 2022. Essentially, that's when the Fed thinks that we'll be back at full employment. So that aligns with the CUNA view. On the other hand, a big miss. We, CUNA economists, were expecting that the 10-year Treasury rate would finish 2021 at 140 basis points, and that it would finish 2022 at 165 basis points. And you can see the most recent reading March end 21 was 1.74%. So we've seen a pretty big increase in a short period of time. Essentially, this has blown through our forecast, and I do not expect these numbers to come down at this point anytime soon. This is simply a reflection of the fact that bond markets, not that bond markets believe that inflation is going to be out of control, but that things are sort of returning to normal from a pandemic standpoint, that the economy will be growing very, very quickly. And so the better opportunities for investments at this point lie within equity markets rather than within the bond market. And so we see bond markets selling, and a consequence of that, of course, is higher interest rates. So what does this mean? Well, a couple things. It means, all else equal, that on the long end of the curve, credit union asset yields will be modestly increasing. Again, that's on the margin. So additional new assets that are being added to the balance sheet, whether they're longer term investments, midterm investments, or say mortgages, longer term loans, those yields will be gently rising as we look forward, and actually will be quite a bit higher than we anticipated. The bad part about that, of course, is that it's likely to mean that loan demand is going to go down. That's especially true with mortgages, very, very sensitive to long-term interest rate movements. And so we will see a big drop off in mortgage refinancing activity, for example, and a consequence of that is, again, fewer gains on sales of mortgages. So there will be some bottom line related effects to the decline in loan originations overall, as well as to this expected decline in the fees associated with sales into the secondary market. The other part of that, of course, is that we might actually see a shift from longer term borrowing to shorter term borrowing in the consumer lending sector, credit cards and unsecured personal loans and that sort of thing, automobile loans, as the economy improves and as more people benefit from the improvement. So all in all, a little bit of a miss there on the long end, and the is kind of a mixed bag from the standpoint of implications. There should be some marginal declines in ROA and some increases in ROA related to perhaps additional loan volume on the one hand, and then sort of a broadening out of spreads as those low rates, synonymous with what we're paying our depositors, stay low, and the high rates actually become a bit higher. So the last thing I want to cover is something I'm calling bonus material. And this actually comes up because we've been talking to credit unions now for the last couple of years about ways to better measure and report impact, to track the difference that you're making in people's lives, and more formally to do that in the context of financial well-being for all. How are we changing people's lives from a financial perspective? How are we making them healthier, not only financially, but physically, and all of the other ancillary effects that financial health has on people's lives? One of the things that we've been tracking, as you know, for the better part of 25 years is the direct financial benefits that credit unions provide to members and the indirect benefits that we routinely provide to non-members as well. Our mere existence in the marketplace helps to ensure that non-members, bank customers, actually enjoy better deals from the standpoints of the rates they pay on loans, their savings yields, and the fees that they pay than they would otherwise. Credit unions do make a difference because they influence the pricing behavior at banks. So for the better part of 25 years, I've talked about basically those higher savings yields, lower interest rates on loans, and fewer and lower fees to members. And you can see in 2020, those totaled $2.45 billion $9.25 billion and $1.24 billion respectively. We arrive at that calculation simply by looking at average interest rates and average fees at credit unions and banks as reported by DataTrack and applying those differences to the credit union balance sheet. And those are very substantial benefits, obviously. The one that's come up recently, this actually happened right around the time of our GAC this year. Greg Micklig, our chief engagement officer, said to me, a credit union just reported that they paid a pretty big bonus dividend. Do we have national data on that front? And as you know, bonus dividend data is not reported on the call report. And so I said, no, we don't. And then got to thinking about it and realized, actually, we do have survey data from about 100 credit unions that attended GAC and opted into our financial benefits calculation prior to GAC. So every year prior to GAC, we open up to any GAC attendee the opportunity to input data for their credit union. It takes about 5 minutes to do that. And then we calculate an implied financial benefit for members of each individual credit union. So we had 100 observations on that data. And one of the things that we ask, which is not included on the call report, is, did you pay bonus dividends? And if so, how much? And so we used that sample of about 100 credit unions to gross up the implied bonus dividend total for credit unions throughout the nation. Turns out about 15% of credit unions actually granted bonus dividends. And when we take that 15% overall, apply it to the movement total, we end up with about $660 million in bonus dividends. Likewise, we went to the call report, and interest rate rebates are reported on the call report. We took the data from interest rebates off the call report to come up with a total of bonus dividends and interest rebates. It's $720 million, almost $750 million. So in total, if we take all of that stuff, plus the nearly $5 billion in non-member benefits that accrue to bank customers because banks price in more consumer-friendly ways when credit unions are in the marketplace, we come up with a total $18.6 billion in credit union financial benefits in 2020. As you think about creating similar analyses for your credit unions, think about all of the good things that you do and the financial benefits that accrue, and take each of those things into account. If you'd like us to try to calculate those benefits at your credit union, we can do that. We charge a small fee for it, but don't hesitate to call us and inquire if you're interested. So that's it on bonus dividends. Well, that's the view from CUNA offices here in sunny Madison, Wisconsin. If you have any questions on any of the material I covered today, don't hesitate to contact me directly at mschenk, MSCHENK, @CUNA.coop. If you need other data, information, tools such as calculators and that sort of thing, come to the website, www.cuna.org/economics. Thanks again for joining. Thanks to Co-op Financial Services for their continued support. I hope to see you all again next time.